Guys, thank you for coming and showing up to today's webinar. We have a special guest today, a market wizard. Our guest today is Tom Basso, and our theme is the beauty of automated trading in navigating the uncertainty in financial markets with Tom Basso. I'm going to read out his bio so you can understand who our guest is. Tom Basso started investing in mutual funds with money he earned delivering newspapers at 12 years old. As he was completing his chemical engineering degree at Clarkson University, he started tracking chemical and oil company stocks to help decide where he would eventually work. A few years later, he and a friend started an investment club primarily targeting stocks and started systemizing their approach to be time efficient. That led to being one of 3 partners in Kennedy Capital, a St. Louis-based small-cap stock manager. There, Tom realized that the firm had little in the way of diversification should a bear market in stocks come along. So he encouraged his partners to start a futures trading strategy and registered as a US commodity trading advisor, that's CTA. In 1984, Tom left Kennedy and formed TrendStart Capital Management to concentrate on small cap portfolios, mutual fund timing, and futures programs. After growing TrendStart to over $100 million, Tom decided to explore the very large Forex market and created TrendStart's flagship World Currency Program. That successful program grew the firm's asset under management to 100 to 600 million US dollars. When the euro was invented in Europe in 1997, allocators started pulling cash from the entire Forex industry, including TrendStart. With a decline in assets, more regulation after 11th of September 2001, and a variety of other personal reasons, Tom decided to retire from the industry in 2003 at 51 years old, and today Tom is going to 69 years old. Today he manages his own assets in ETFs and futures and participates in Forex markets by way of US futures contracts. He is no longer registered and decided to help other traders improve their performance using a website, enjoytheride.world. He speaks frequently to other traders as he is doing today, has written 2 books, has done a few seminars, has a book of his interviews coming out in March of this year with Michael Covell of Trend Following fame, holds a few webinars here and there, and enjoys life. So Tom, welcome so much to our interview today. We are happy.
Thanks, Sylvia. Yeah.
Yes. So we're starting off 2021 with you, and it's truly an honor to have you. So maybe you can start.
It's an honor for me as well.
Yeah, I've read your bio, but you can tell us briefly about segmenting your trading journey, how it's been, finding your path in money management, and developing trading systems for automation.
Well, one of the things that struck me from your introduction and reminiscing about my whole life is how long and arduous, I think the word should be, of trying to discover little tidbits of trading knowledge just 1 year at a time. And I kind of reminisced at all the different stages that you went through in my career and how much I thought I had learned at each of those stages and the things I picked up. And, you know, when I was a paper boy delivering newspapers in Syracuse, New York, at 12 years old, I knew nothing about investing. I just knew I wanted to go to college, and I knew my father delivered mail. And I knew that there wasn't going to be a lot of money there for going to chemical engineering school. So I tried to save. I was a very good student. I got a lot of scholarships and was able to go to Clarkson and get a great chemical engineering degree. But what you learn with trading, if you do it the way I did it, is you have to sort of peel back the layers of the onion 1 layer at a time and try to figure out how to deal with how am I going to buy and sell, and how am I going to size my positions, and what markets do I want to trade, and what are the details about a market. And so it's been a journey where I started out back in the days before computers. and I had pieces of graph paper and chart paper, and I did everything with pencil and paper. And calculators came in right around 1973, roughly. You could add, subtract, multiply, divide. That was it. Probably by about 1974, if you really wanted to spend 200-300 US, you could get a fancy calculator that could actually have a memory function or a 1/over function or something. But these were, nobody even makes a calculator as simple as these were back in 74. And when I came out in 1974, it was the end of a 50 cents on a dollar bear market. So stocks had gone down in the US by the S&P 500 50%. So that was fresh on my mind, and I realized that stocks have risk on the positive side of making money and on the negative side of losing it. So I've always been a numbers guy. Chemical engineering background lends itself to a lot of math, and I always look at the data and a lot of the world as sort of a chemical engineering problem to solve. And chemical engineers are very good with process. You have to, bring in chemicals, you have to process them, you have to ship them out. And a lot of trading is the same thing. You're bringing in information, you're making decisions with it, and you're shipping out orders. So I looked at that the whole trading problem as a chemical engineering problem, and that's kind of the journey that I've gone through, just continuing to optimize the ability of processing that information and getting the orders out. And what I'm doing is just constantly expanding and fine tuning and making better that process.
All right. Today you're a grandpa and you have been trading to date, even as a retired man, which is very impressive. So you can tell us about the beauty of automation in trading. Most of us are not automated traders, but there are some few people who are automated traders. So you can tell us the merits for becoming an automated trader and what an expert advisor is to the new traders.
Well, automating your trading is nothing more than taking, to me, the mental process and the decision process that you go through as a manual trader and having a computer do it instead. So, for example, if I make a simple example where you go to a previous high in a market and you want to buy on a stop as it goes through that previous high and trend follow the market from there, let's say. A computer can read that data, determine that point, and put an order in one tick above that if that's what you want to do. You just have to mathematically describe that in computer code. And there's lots of increasingly numbers, not, I wouldn't say lots, but a lot of more platforms nowadays than there were certainly when I started. I had to create a lot of the software myself for TrendStat and so on. But what you're trying to do is to explain down to the detail exactly how you as a human being look at your chart pattern or look at your numbers coming in and say, if this happens, I'm going to do that. If that happens, I'm going to do something else. And that's the process of automating what you're doing. And I would encourage those that seek automation to be very, very patient, because it took me $1 million US and probably the better part of a decade to get to the top level of automation that TrendStat had back in the days. And I had a team eventually of 3 people programming full time. So, and I programmed myself before I hired the first programmer. So it was a long process, and of just getting better and better and adding another feature and fine tuning and figuring out that that didn't work. And so you got to be patient, but as you progress, you'll find yourself sort of putting yourself out of the trading business. No longer will you sit there and watch charts and worry about the data and all that, because you'll have computer processes that do those same things for you. I see human endeavor in 2 different levels. There's the level of human endeavor where you are actually doing something. So it could be sweeping the floor, it could be cooking the dinner, it could be anything of an activity. Then there's the other type of human endeavor, which is, I think, the artistic and the creative side. That's where you're inventing new things and you're creating art and you're creating music and doing all that. I think human beings would rather be on the creative and artistic side. It's a lot more fun. And so to me, working, trading, and doing just, say, manual day trading, you're doing an activity. You're not being very creative. In fact, you're trying not to be creative. You're trying to be very disciplined and do what you do over and over again. And it kind of gets boring after a while. You'll find yourself making mistakes every now and again mentally. It's hard to stay in that game. Being creative, like creating a program that would end up being able to replace you so that you don't have to sit there and do that, is a creative project, and it's developing new things. And it's to me, it's very satisfying and uh, helpful in making your life more efficient and not liberating you from having to do that routine activity all the time. So that's one of the reasons why I went so deep into automation. It was just putting myself out of work, basically.
All right. And then with technology coming in, even in finance, would you say confidently that automated trading is the future of finance, given the technology advancement? And also, maybe you can touch on a strategy called Martingale that some people here use. And what's your take on that?
Okay. Technology will continue to take over more and more of our lives, because what ends up happening is it will push human beings to have more ability to be creative and be artistic. So even routine things like making a simple meal probably would be done by a robot someday, because you'll want to go do something else, and then all of a sudden your dinner will show up. The trading is no different. You'll find platforms getting better and better to allow traders anywhere in the world to access data anywhere in the world, to do whatever they want with their trading, to go long, to go short, to hedge, to do straddle trades, to do options. All of that continues to evolve. So I believe you'll continue to see that. Now, my understanding of a martingale, from a, say, a Las Vegas gambling standpoint, is the simple things like, if you take a loss, then you double your next trade or something, and you try to have another trade that'll make back the loss and then some. And then if you lose on that trade, then you'll double it again, and you keep doing that until you try to get ahead. That's my definition of a martingale. If you've got some other definition, you'll have to explain. But martingales are dangerous position sizing from the standpoint of, if you have a successive nature of losing trades, increasing your position sizes into that drawdown will eventually lead to ruin. Statistically, it's a very small probability, and many people don't see that statistically. They figure, well, that won't happen to me. One of these along the way will be a success, and I'll get back and make new highs. That's a dangerous game to play. Sooner or later, I kind of liken it to diffusing bombs or something. If you diffuse 49 bombs successfully, but the 50th goes off, what have you achieved? You're dead. And I think that's kind of where I see a lot of things happening with those types of position sizing and money management strategies. Unless you have a different definition of martingale, that's what I call a martingale.
Yeah, it's actually a series of successive losses and then recovered in one big win, basically.
Right. Yeah, I'm not a fan.
Okay. All right. Thank you, Tom. Thank you, Tom, for that. Now, regarding behavioral economics, which you're a believer of, how does that tie into navigating the uncertainty in financial markets, especially for system developers such as yourself, and also for traders?
Well, you can use it or not use it, but it helps my understanding what the world's doing out there. So I can try to anticipate what types of new systems and automation I might need to put in place to deal with it. Behavior economics to me is asking yourself, when you make an economic decision, whether it be increasing taxes in a certain country or decreasing interest rates in a certain country. Back in the days when I was trading Forex a lot, it seemed like I had to have a working knowledge of why certain traders that were, like, say, buying high yield currencies and selling low yield currencies and working on a spread, why they were destined to probably fail sooner or later, and why I want to avoid that. And behavior economics is a type of thing where you're trying to use human behavior to predict the outcome of various economic decisions. So, a simple example: a country raises taxes. What's going to be the outcome of that decision with the people who you're taxing? They're going to try to avoid those taxes. It's simple behavior. Why would you want to pay more rather than pay less? So what you're trying to anticipate then is the revenues that country will get from those people will not be as big as they think it is. If they're already running deficits, they'll probably continue to run deficits. The currency may not perform as well as it thinks it's going to. So behavior economics is just as simple trying to understand what human beings do. If a price of something is higher, they're less likely likely to buy less of it. If it's lower, they'll buy more of it. If a government subsidizes something, you'll get more of it. If government raises the minimum wage to some level, you'll get less jobs. So it's a way of getting ahead of and thinking about the future. And it doesn't necessarily mean that you don't take that buy signal in the S&P contracts this morning because some behavioral economics things, unless you want to trade discretionarily. But it helps me understand and it gives me a nice background in the way the world works.
Okay. And you're an author of 2 books, Panic Proof Investing and Successful Traders Size Their Positions, Why and How. What went, or what were you thinking of when you wrote these books, and why would you recommend them to traders?
The first one, Panic Proof Investing, I wrote for my clients back in the Trendstat days. I found that most clients don't realize this, and I don't even think most money managers realize this, that clients are giving you money, their money, to manage as a money manager. And a lot of money managers take the attitude, I know what I'm doing, I manage my own money. If you want to come along for the ride, feel free. And I'll manage your money and I'll charge you. That's an approach that a lot of money managers take. And I find that because the money managers know more about trading and risk management and have a higher risk tolerance, the clients and the money managers' techniques are many times mismatched. Clients can't take on psychologically the risk that the money manager wants to take on. So they eventually come, give money to the manager, and then they leave and take the money away from the manager, usually during a drawdown. So I thought to myself, if I could make my clients more intelligent and understanding the process, then they would allow me to be a better money manager, and I could actually do the things I need to do. So I wrote that book to try to elevate their education and knowledge about the process of good investing, so that hopefully my clients would give me the ability to be a better money manager. And that was the background behind Panic Proof Investing, which I had originally entitled Frustrated Investor, which I think was a better title, but Wiley and Sons somehow they decided to change it on me. The second book, which I self-published, and therefore there was no Wiley telling me I could had to change the title, was The Successful Traders Size Their Positions, when I did studies back in the Trendstat days, I clearly found that it's a lot more important to size your positions properly. In other words, how much do I buy and sell rather than do I buy or sell? A lot of traders think of themselves as looking at charts and markets and then working on indicators and deciding they're going to go this way, buy now, they're going to sell here, it's all buying and selling. And they ignore the whole position sizing thing and just lock on to, I just do 1,000 shares, or I do 500 shares or 100 shares or 5 contracts or whatever the number is. When I've done simulations, I actually found that if you can size your positions more logically, that actually has more impact to your results than does the buy sell decision. I did the random numbers study, which has been quoted a number of times, where I just flipped a coin. Every afternoon, you flip the coin, get in the next day at open or close, or open, buy or sell, And once you're in the position, you trail a stop, you size the position properly, and you do that across a number of different markets, and you find yourself making money over the long run. Why? Well, you're limiting your loss by the trailing stop. You're letting your profits run as far as it wants to, and you're properly sizing the position. If you don't properly size the position, you'll end up slightly losing money. And I think that made a big impact to me, that position sizing is very important for a number of different things. It helps your psychology because it smooths your performance. It improves your return to risk ratios. It keeps you from those, debacles in blowing up to the point where you never can recover again, the ruin situations. And so it became very important. And my wife had some rehab that she was doing on a shoulder surgery. So I would take my laptop to the rehab sessions because I had to drive. She couldn't drive to the rehab sessions, rehabilitation. And so I just sat there in the lobby with my laptop and I cranked out that whole book in about 2 months. And so I published it, a couple of years ago now. It's sold thousands and thousands of electronic copies around the world. That's been very popular with people.
Thank you. Thank you for even putting that thought process into these books and providing it for traders, because it is true that position sizing, and it's not the first time we've heard of that from trading experts such as yourself, that position sizing is very, very important. So thank you for also putting that out there for traders so that you can be able to gain that insight from you.
Yeah, and now, Tom, you can share with us your screen, and then you can take us through how automated trading for you has helped you navigate the uncertain markets, whether be it in Forex, whatever you have been trading. So looking forward.
Okay, I am going to try to share the screen now. All right, can we see automated trading?
Yeah.
Yes.
All right.
And also, we welcome any questions on the chat section. Tom will be able to answer towards the end of the webinar.
Okay, so we're going to talk about automated trading, and I think the first thing we got to talk about is, what is a complete trading strategy? Is that easy to see? The complete trading strategy?
Yeah.
Okay. What I have in red are the things I'm going to touch on today from an automation standpoint. But a complete trading strategy in a lot of traders' minds is just buy sell. They're worried about what markets am I going to trade. That comes in from portfolio selection, where I have the cursor here. And can you see the cursor?
Yes.
Yeah.
Okay. Then you're worried about buy sell engines. A buy sell engine is nothing more than any kind of indicator that tells you what you are buying and what you're selling. And it has nothing whatsoever to do with position sizing or what kind of markets you're going to trade or anything. And it doesn't help you necessarily with your mental side of trading, which I'll touch on. We'll also talk about sizing the position. As I indicated, I believe that's more important than the buy-sell decision. And the third area that's essential to be successful in trading is the whole mental side, the self-responsibility, the self-awareness, the mental side of dealing with losses, and the markets love to push your psychological buttons, and have a great way of doing that. And do you have discipline? What kind of mental states are helpful and hurtful? Contingency planning. I mean, with another gentleman, I do seminars every now and again. We haven't done one in the last year because of COVID and everything, but we talk about this stuff for 2 days. It's not something for a half an hour, but that to me is what a complete trading strategy is. And if you don't have all of these things put together, you don't have a complete trading strategy. You've got a partial one, and the markets will try to find your weakness and exploit it. Back in my chemical engineering days, you're trying to control temperatures in a reactor or a heat exchanger. You've got the ability to measure the temperature and then decide when the temperature is doing an excursion from that. So I look at everything as noise and data, information. So here's a market, doesn't make any difference what kind. A sideways period where the markets are going up and down, I call noise. You're not going anywhere. If you buy or sell, you're not making or losing any money because the market isn't going anywhere. It's just noise. So you really don't care about that. What you want to do is to figure out when markets are going to move one way or another. That becomes data and information that you want to act on. And this is 1 minute bars. The last one was daily bars. This happens to be Amazon stock, but in 1 minute bars, you got noise, you got data, you got data. If we look at weekly charts, you got data, you got data, you got sideways, noise. So it happens no matter what time period you're in. There's always going to be some noise. There's always going to be some information. Your job as a trader, in my mind, is to separate the two. So noise is relative to the time frame measured. And the more room you give for noise, to ignore noise, the later you will signal your actions. So if you want to dampen, it's called over dampening in chemical engineering terms, you're dampening the instrument so the instrument never makes a decision and never does anything. So if you do that and you put your noise measurement wide enough, then it'll always be noise. You'll never ever get a signal to buy or sell. The more room you give for noise, the larger the risk per trade. This is why when you have a very volatile market and you get way out there on your signals, away from the market, so you give a lot of room for the volatility, your stop points potentially are going to be very far away from where you are when you're buying, and therefore a lot of risk per trade. And if you size your positions the same way with that larger risk, you'll end up with potentially much more danger in your portfolio of blowing up. And then the less room for noise, the more false indications or whipsaws you're going to get. So you'll be in and out and in and out, and that's not a whole lot of fun either. So selecting a time frame for traders is a critical thing. And strangely, I'm going to approach it from a different view than most of you listening probably would guess I would. Here's a daily 21-day indicator. This happens to be a Danshan 21-day channel, just for example purposes. And on the page, you'll see 5 trades. There's 4 listed here, but you got one back here when we started the trade, back here someplace. So you got 5 trades, you got 2 good runs, and you got 3 whipsaws in 6 months. Now, if you then go to a 50-day indicator, same thing. You only got 3 signals, 2 profitable and 1 whipsaw. So it isn't necessarily the case that you want to be shorter and shorter term, but at the same time, going to 50-day makes these lines farther away. Therefore, the risk on each trade is larger, and it takes a lot longer for you to get out of the noise and into the information. Here's a 10-day indicator, go the other way. Now you've got, let's see, 3 profitable, 6 whipsaws, and you've got, some nice runs. I mean, this is a nice run, and you got a nice run here. You got a beautiful run there, but you got a whole bunch of nonsense through here as you're trading the noise. So the shorter term you get, the more whipsaws and more sensitive you are to the noise, and the larger you get, the more risk you have per trade, the less signals you'll get as a trader. And if you're busy in a day job someplace and you have a lot of other things to do, always go to the longer term, as I indicate here. Start longer term and move to the shorter term. It's easier to make once every now and again decisions than to try to make decisions every other hour, psychologically. Don't trade more than you have to be effective. Trading costs money. A lot of people think of commissions, and of course, commissions have gotten less and less these days. In some cases, you have almost zero commissions, but you have bid-ask spreads, you have forward rates on Forex trading. So there's things that are going to come into play that are going to cost you money every time you do a trade. Sometimes you're just going to get slippage on the trade. You're going to try to get in at 1.2 and you're going to be filled at 1.2010 or whatever, and you're going to have slippage. That's a cost. So don't trade more than you have to be effective. And set your frequency at a point that is comfortable to you and gives you the ability to flawlessly execute. If you're busy all day, don't try to day trade. You can't do it. You're going to get interrupted. You're going to miss trades. You're going to end up in a trade that you can't get out of and take a big loss. You're not going to follow your strategy. To me, that's just setting yourself up for failure. In my case, I was a chemical engineering during the day when I started out, and I was trading my portfolio in the evenings. So I could give myself an hour is all I had. So I designed everything I did to fit inside that hour. Nowadays, retired, I give myself 20 minutes. I have to do my entire trading process in 20 minutes, and I have to execute it flawlessly day after day. So I set my frequency of my trades and what indicators I'm using to try to actually fit within that time frame and what I've got as my capabilities so that I can execute it flawlessly. So let's go over some trend following categories. These are all buy-sell engines. And as I put down at the bottom here, I prefer the right side to the left side, but let's explain what they are. Single number buys and sells could be things like the famous moving averages, exponentials, geometric smooth moving average, relative strength indexes, true strength indexes, money flow. All of those would be examples of a single line, and as they change direction or go through some level, you trigger a buy or a sell. You don't have any logical point to put a stop loss, so you have to come up with a stop loss technique then, and there are ways of doing that. Channel-based indicators would be things like Keltner bands, Bollinger bands, high-low bands, envelopes, price channels, point and figure, volatility stops. Those are all price channels. And what I mean by that is there's a top line and a bottom line around the noise. And because I think in chemical engineering terms and I like noise and information, I like to have 2 lines on the chart, above it and below it. And in between is noise. So Keltners are volatility adjusted using average true range, which is useful because as volatility changes, the bands get wider or skinnier. Bollinger uses standard deviation. High-low bands uses the prices and averages of those highs and lows. Envelopes, same way. Price channels and Donchians use the highest high and the lowest low of the last X periods So it's sort of volatility adjusted on the fly. Point and figures similar to Donchian. Volatility stops usually things like average true range to set those stops. So they're all logically based on the conditions in the market, and they give you a high and a low. And I prefer that if I'm trying to look at something. There's one wrinkle that I learned a long, long time ago from other traders. I didn't invent this. Don't move your stops away from the market. Always move them towards the market. In other words, if you look at the spot right here and the Keltner band starts going away from the like right here especially too, where it starts moving away from the market, it goes up and you're on a sell over here. I keep the stop exactly the same at that point. I don't ever move my stop farther away. And that's just an old trader's axiom to protect yourself. So here's an example of what something like a Keltner band does with volatility changes. Look at these periods between the lines. So here's a very, very highly volatile period, and look at the arrow I drew here and how large the distance between these two lines are. That is normal noise that day. Looking back, whatever, 21 days perhaps or something, and averaging it. So you've got a lot of volatility in the market. Your lines are going to be very separated. The market goes quieter and quieter. The noise gets smaller and smaller, the variations. So now look at the distance between the lines. Compare this to this. And that's all in a period of just 4 or 5 months. The conditions have changed, your indicator changed. I like that because the indicator is trying to change itself on an ongoing basis on the fly, not re-optimizing it or anything, just it's constantly changing for the conditions that exist in the market. And I like indicators like that. I believe they're far more robust and have a chance of lasting long term a lot more than static indicators like a 50-day moving average or something simple like that. 50 days may be optimal this year, but next year maybe 60-day is optimal, or maybe 40-day is optimal. And I don't want to have to constantly keep changing my indicators. I'd rather just stick with something that changes itself. And I think that when you have volatility-based indicators, you can do that. So increasing the frequency, going intraday, as a lot of people in the trading business, especially starting out, think that trading intraday is really trading. You know, you get up in the morning and you have your coffee and off you go to the quote machine and your trading platform, and you trade all day and you're stressed out and you're exhausted at the end of the day. That's the vision a lot of people have of trading. That's not the vision that I have. But there are some advantages of day trading. For starters, you're going to have a lot of data with very, very small risk levels, because the point to your stop, if I draw, this is a 3-day or 3-period 5-minute bar Donchian channel. So you got 7 trades, 4 of them were negative, 2 were small profits, and you got 1 very large profit right through here. The short sell was a biggie. And you did that in 2 hours. So the advantages are several. Your risk level's low, so you can trade with smaller amounts of capital. The negative, of course, is it takes you all day to do it, and you can't do anything else because you got to pay attention to what you're doing. The other advantage you've got is something I called statistical sample size. When you're an automated trader, I'm fond of saying your job is to get to the next 1,000 trades. Quit worrying about this one trade. Psychologically remove the pressure on one trade and push it out to, this is just one more data point in my next 1,000 trades. When you put it in that perspective, you realize that this is just 1/1000th of my future sample size. Well, when you're trading intraday and you can get 7 trades inside of 2 hours on this example that I pulled, and you've got maybe 6 or 8 hours a day of trading, now all of a sudden you may have 20 trades in a day. you're going to get to your 1,000 sample size a whole lot quicker than I would trading in the afternoon for 20 minutes a day. And that might take me several years to get to 1,000 trades. Well, think of the 1,000 trades as your sample size to get you the results that you seek. It's not the 5 losing trades you had in a row in 2010 that is everything about your strategy. It's the 1,000, the good trades, the bad trades, the so-so trades that all added up become your trading success. So any one trade making a profit, you should think the same thing. This is just another trade on the way to 1,000 trades. So you don't get excited over your profit. You don't get the negative and down on your losses. You get one more trade towards your 1,000 trades. Think of it that way. So automating your portfolio, I created some simple examples. And so let me go back here. And now we've got to get out of here. And let's see, can you see, are we seeing my platform now?
Yes.
Okay. So I created a simple portfolio to show some examples of just some of the things you can do with automation that to me make a lot of sense. I threw together a 5 contract portfolio. Here I got crude oil, gold futures, a euro, soybeans, and lean hogs, just to create an example of a portfolio. I called it Sylvia's Lounge portfolio. And I created a Sylvia's Lounge strategy. And so we named it Sylvia's Lounge, and we're going to use that portfolio that we just created. For simple purposes, I'll keep the slippage to 0. If you're wanting to do a legitimate test, I think you probably want to have at least a tick or 2 of slippage. And then let's throw together a simple strategy. Let's use a Keltner band, and well, let's start with 21 days. And we'll do an average true range of 21 days, and we'll use the ATR multiple of 2.0. And let's use the same thing to get out. And we use the upper line for the buy signal, and we won't use the upper line for the sell signal. And let's just keep this simple and do a fixed size of 1 contract each, and we run it. So think of that. I just explained this, and I just set this simulation up in, what would you say, 40 seconds, maybe 45 seconds. I hit this, and it's running 10 years of data across 5 different contracts and running the strategy, and it's done. And it's already going to give me a spreadsheet. In this case, this particular platform would give you that. Other platforms would give you a printout. And now I've got a spreadsheet that I can play with and format if I want and get the columns right. I can go down to the bottom and see that I started with $1 million and I ended up with $1.107 million right here. And I can look at other statistics. I'm going to spare you that just right now. I've got a summary in a little bit that'll cover all the different cases we're running. But I mean, that's just, I just did this all in about, what, a minute or 2? Can you imagine doing this all day? You could cover a lot of different cases and do a lot of simulations and learn a lot about what you're doing. So let's just try something different here, and let's say, oh, well, you know, I got to 1.1 million. Let's see if I can improve that by adding another indicator. So let's add a Donchian and see what happens. We'll stay with fixed size. We just want to add the other indicator. So we'll run it again. And about 8 seconds later, you have a result. And you got another spreadsheet. And going down to the bottom of that page, you got to 1.18 million. So that's a little bit different. And you might say, well, that overly complicates it, so I don't necessarily want to do that. So let's get out of here. And let's try to do something else. Let's keep it simple and get rid of the Donchins and go to 9-day. See what the effect is on that. And run it again. And there's another 8 seconds or so. We're going to save it. We're going to open it. We can look down at the bottom, and now we're at 1.15200. So what you're seeing here is the ability to use your own mind to say, well, you know, it doesn't make sense to fix size. Why would I want to trade one contract every time? How about if we at least size our initial position for 1% of equity in the case of risk? So that's the risk of where I'm getting in to the risk of where I'm getting out, the price getting in minus the price getting out per unit, which in this case was contracts because we're trading futures. And I'm going to divide that number by the equity, and I'm allowed to have as many contracts as I want as long as I don't go over 1% of my equity in the portfolio. Now, what that's going to do is when the risk gets bigger, my position size will get smaller. When the risk gets smaller, my position size will get bigger. Very logical, and my book talks about the math behind that. It's pretty simple. Multiplication and division, it's not hard. Volatility, same thing. A percent of equity, say 0.8% of my whole equity. I'm willing to let a position go up and down by 0.8, and I'm okay with that. So let's save and run that. And we save it, and we open it, and we look down. Now we're up to 2.2 million. So we've just made some progress, and we've all done that in about 6-7 minutes maybe. And my point is you can get a lot done when you are trying to do this type of thing. And what I want to do now, let's see, I want to share. Where's my share button? Zoom, share. And I'm going to go back to the presentation. So are you seeing the, are we seeing a summary of simulation runs?
Yes.
Okay. So here, to save some time, I'm showing you the summaries of, well, probably 15, 20 minutes worth of work on my part. And I'm just trying to lead you through the mentality that I would use in trying to do various simulations in an attempt to automate your trading. I started out with 21-day Keltners. That was this first case. And sort of the base case would be that we were looking at an ending equity starting with $1 million of 1.107 million. A drawdown when I added some statistical things, and I kept it simple. You could add, I could make a giant grid of 10 different return to risk ratios and maximum drawdowns and average of the worst 5 drawdowns. And there's all sorts of other stats you can get. Tried to keep it simple. We don't have a lot of time. Down 11%. Return to risk on this one was a very lousy 0.09. When I added the Dungeon, I got a little bit improvement on the maximum drawdown. The return to risk wasn't outstanding. When I went to 9-day, I improved the results a little bit over the base case, and I dropped the drawdown even more, and I doubled the return to risk. And now you're starting to think, maybe I'm on the right track here. Let's explore that a little more. So let's keep it at 9 on the Keltner, and let's throw in some initial risk levels. And we ended up with 2.2 on the capital. But look what happened to our drawdown. Now we have to mentally suffer through losing 33% of our capital before it recovers. That's kind of tough to do mentally, but the return to risk ratio was a whole lot better climbed up to 0.24. So I might say to myself, I don't like that 33.6%. That's trading a little too leveraged. How about if I drop my initial position sizing in percentage terms a little lower? Well, yeah, it creates a lower return because you're putting on a smaller position. It did reduce the drawdown, but not as much as I would have loved. The return to risk stayed pretty even, but dropped slightly. So how about if we look at ongoing position risk? And that is to say that once you're in a position and the position's starting to make you money, are you just going to let it grow and grow and grow and grow and pretty soon swamp your portfolio and be, 90% of the value of your portfolio? Or are you going to limit it and manage your position size throughout the trade, which I recommend highly? So let's try 2.2% and 0.8%. Well, that dropped it even more. So 1.9 went down to 1.4, but we went the right way on the drawdown. So that was good. We really killed the return to risk. So that, how about we go the other way? We let the positions run a little bit more and go to 2.7% of equity and a little bit more on the volatility. Now we moved up on the returns. We got to 1.5 and we dropped by another 3% the maximum drawdown, which is a good thing. And we increased the return to risk ratio. So as I look at these cases, this one would be more for the person who can tolerate the risk, perhaps, because you're trying to make as much money as possible and you've got a pretty good return to risk ratio. This one might be one a little bit more for me because I'm retired and I don't need the risk and I can maybe tolerate a 20% or so drawdown. I'd rather have a fairly high return to risk ratio compared to that initial base case, and I've made a decent amount of money. So that's the mentality I use. And if you're sitting there doing simulations, you saw how fast it was. You really can, once you have a platform and good data and you got your portfolio set and a lot of these decisions made, you can play with your parameters a little bit. And when you're moving the simulation in the correct direction, keep trying to explore that direction. When you're moving it and it looks like it's getting worse, well, then you got to kind of say, man, I'm not sure I want to go that way. That doesn't feel comfortable. And your goal is to try to find something that feels comfortable. So when you look at automation, you've got advantages and disadvantages. The advantages to me is you can leverage your time. We just did it. I mean, 8 seconds, we're running simulations over 10 years. Can help you understand your strategy. Well, you can kind of dig down. I didn't do it, but on those spreadsheets, I could have gone into every market, every single trade, and I could go look at where that maximum drawdown was that I had to suffer through. And I could try to study those periods and try to understand how the math I used, in this case, Keltner bands over 9 days, effectively gave me buy and sell signals and how my position sizing worked. And I can dig into the detail and spend some time, and that isn't 8 seconds, that's like an hour, studying and trying to understand how the strategy reacted to the data and could I think of better ways to react to that data. It can be used in various time periods. I could have fed the computer 5-minute bars. I could daily bars, weekly bars. I could have fed it anything I wanted. The indicator doesn't care. It's just going to do the same thing. So you can use various time periods designed to give you a trading strategy that fits in your time strategy, your time commitment and your ability to trade. You can have multiple strategies. I've got a friend that runs 50 strategies automated simultaneously every day, once a day. And he does it just in the stocks. He goes long, short. He has mean reversion. He has long trend following, short trend following, and he does it all with a computer. And it's easy for him to do, and that's possible. I trade about 4 strategies. I think that's enough. I think he overdoes it, but he and I have that conversation from time to time. It can help you keep on your strategy. What you find is you start out automating and then you get this buy signal and you look at it and say, boy, I don't feel comfortable with that. And you step in and override it. And you'll quickly discover that that's a big hassle because now your computer strategy thinks you're supposed to be long and you're not long because you overrode the strategy. And when you miss out on a nice big run or you take a big loss somewhere along the way by overriding things, you will learn very quickly that it's a whole lot easier to let the computer do the work and just stick with the strategy. So it helps give you a little bit of discipline, but it's not a sure thing. It's not an absolute must that you do those trades. So it's still up to you, the trader, to do the right thing. Disadvantages. It can mislead you. Do not sit there and hit the optimize button and run 2,000 cases overnight and then pick the best one, because all you're doing is looking at history and you're fighting the last war, not the next war. You have to be able to look at what you're doing and give it flexibility. So set the strategy up so it fits you, so it does what it's supposed to do, but don't over optimize. You can actually get misled that you're somehow going to make 45% with no drawdown, and that's not the reality that you're going to face in the future. And it doesn't guarantee success over any one period. You know, if the strategy is, say, 33% over my lifetime, most of my trend following models were 33% profitable. That means 67% of the time I lost money. There's going to be streaks of 3 or 4 or 5 trades in a row that easily are going to lose money. So just because you're trading automated doesn't mean that every trade's going to be profitable. You have to build that into your mentality. And with that, we have the time for some questions.
Yeah, so Gilbert will take that Q&A session.
Thank you, Tom, for that wonderful presentation. I think for everyone who has attended this webinar has been able to learn a lot, especially when you're talking about the automated disadvantages. I think a lot of people are prone to over-optimizing. And maybe you can, as we wait for people to raise some questions, maybe you can give us some insight as to how to reduce on over-optimizing. Like, what would you consider to be over-optimizing?
Well, for example, if go back to the Keltner example, I went from 21 days to 9 days. Why did I do that? 21 days is roughly a month. It usually gives me about the frequency of trading. I use 21 days a lot because it's about the frequency that I want to be able to look at data. Anything less than a month, I'm a retired guy. I've got other things I got to do all day. I'm not looking to sit there glued to the screen and try to buy and sell all the time. So 21 days is a nice comfortable number to me because that's roughly the trading days in a month. So that's how I selected it. There was no optimization. The perfect solution might be 20, it might be 23. I didn't run 20, 21, 22, 23, 24, all the way up to 30 and down to 15. And why did I do 9? 9's about half that number. It's a couple weeks of data. If I'm trying to be a little more sensitive to what's happening over the course of a week and give it a little extra smoothing out, 9 days seems about right. Just pull it out of the air. I didn't run 5, 6, 7, 8, 9, and so on. I think the best way to try to guard against optimization is to sort of sit down with a sheet of paper and outline where you're going to go with this particular simulation study before you start doing it, and say that you're going to try different periods and pick those periods logically for your time commitments and capabilities. If you're a busy guy all day and you only have, 15 minutes a day to trade, you're going to have to try to pick a time frame that's going to give you the least amount of trades so that you don't overwhelm yourself, because you're not able to follow it very closely. But if you're going to sit there in front of a machine all day, glued to it, well, then maybe you're into the intraday world and you want to try to gear yourself more to that, and you want more trades maybe. So it's a lot depends. I'm a big fan of everybody designing their own trading strategy to suit themselves. Nobody in the world should be trading exactly like Tom Basso is, because nobody listening to this podcast or interview would have my knowledge of computers, my knowledge of the markets, my risk tolerance, my capital that I'm trading, my ability to be equally flexible with securities and futures and FX, because that's my background. You know, you got to design what you're doing for you. That's the only way you're ever going to be successful. If you're fighting it and trying to be Tom Basso, for instance, you're not Tom Basso. So why would that help your cause? Design what you're doing for you. You have a certain knowledge base, you have a certain capability in math or not. You may know a lot about computers or not at all. All of that leads you down the road to a different decision and different place than where I'm going to be at, but it doesn't mean you can't be successful. So that's what I would try to encourage everybody to get to.
All right. And what's your take on people who sell systems? There are quite a lot of automated systems out there in the market.
If I call those black boxes. If they're black boxes and you don't understand what's going on inside the black box, I would take a pass. There's no way that I'm going to trade something and be psychologically comfortable with somebody telling me that I need to buy here or sell there, and you're not going to tell me how you're doing that, or how much am I doing, how much contracts, or how much FX, or how much shares of securities that I'm going to be buying. I don't care how sophisticated the black box. I don't care about its track record. I don't care if it's a genuine or completely fabricated. I'm not going to trust it psychologically, because sooner or later there's going to be a string of losses. And when you don't know what's going inside that box, you will have zero ability to be able to trust it. And you don't know where the end is, and you're getting beat up. And unless you've really understand what's going on with that decision making, you're going to have a very shaky psychological structure. So it has nothing to do with the track record. It has nothing to do with how brilliant or not the black box is, the expert system is. If they'll let you understand what's going on inside of it, I may be okay with buying something that would allow me to execute that every day. I would not do it unless I could understand and be comfortable with what they're doing.
All right. Noel is asking, for someone who doesn't know much about computers or math in relation to trading, but is interested in learning and doing automated trading, where would they begin?
Begin at the beginning. I wasn't born with a knowledge of computers. I had no idea. Day by day, week by week, year by year, there's courses. I'm taking a course in C# right now in software language, and it's totally on the computer. It cost me $11, and I get this huge course in C# language. So there's very inexpensive ways of learning. You sign up for a virtual course, you start doing the exercises, you practice, you get better, you start applying that knowledge base to a practical problem in trading. Maybe, how do I size my position? I'm going to put this number in, and it's going to spit back a number of how many I should do. And then you create the little project for yourself, and you automate that little part of your trading. And then you say, well, what I'm doing over here on the indicator could be automated. If I could get this data into a database, I could then write a little program, and I'll do that. And now you got your buy sell decision maybe automated. So then you take these two modules and you stick them together, and you say, okay, if I run the data and I get the buy sell decision, and that gives me then my risk, and I feed that variable into this other module, it'll spit back how many I should do. And then you say, well, yeah, but then I got to manually put it into the broker. Oh, well, they have these things called APIs, automatic programming interfaces, that say at Interactive Brokers or other firms have. And you could say, okay, now I'll take this order of buy this at this many at this price, and I'll use this interface, and I'll write a little program that connects to my broker and sets up the transmission of the order. And little by little, as you work through these little modules and keep adding them together, you find yourself doing less and less actual hands-on trading and more programming the next module to eliminate that part of your day. And pretty soon you're fairly automated. That's the way I do it. It's one day at a time. It took me years. You got to be patient. You got to test like crazy. You've got to think it through and start the project and put some specs on it and just kind of start muddling through the process. But nobody is born with a knowledge of computer automation. There are some simulation packages that will try to get you there without you having to program. I don't know that there's any that I really love. The one that I showed on this presentation is one that I'm helping to develop. It's not going to be ready until sometime in 2021. It's at an early stage at this point, but it is functioning at a minimal level now. And we hope to, in the next couple months, be actually using it and beating up on it each day as a trader and using it in real trading. And then by sometime in the year, we hope to offer it to people. But none of the packages out there are perfect, but they can help if you don't know programming. They usually will cost you some money. So it's a question of how much do you have to spend. If you can build your own, you can do it to a certain extent a lot of cheaper from an out-of-pocket standpoint. You don't have to pay a lot of money, but in the case of time, it'll consume a lot of your time.
All right. There are two other questions relating to your books. Are there soft versions of the two books that you've written? And also, will your up-and-coming book, Trend Following Mindset, be available in Audible?
Michael is taking care of, Michael Covell, that is, of Trend Following fame, is taking care of a lot of the details with the publisher. I think right out of the gate, there's not going to be an Audible. There'll be a hard copy, and it'll cover a lot of stuff. My favorite part is the foreword of the book, which was written by my wife, Living with Mr. Serenity. That I laugh every time I read the foreword. Because she nails it pretty well. The interviews are very good. It's kind of the closest thing I'll ever have to a biography of my life. It covers so many stories that I tell Michael about everything from being a paper boy and delivering and buying mutual funds to, finding out about risk and money, volatility management, and the process of automation, the process of mentally calming yourself down and being a good trader from that standpoint. So there's a lot in there. It goes on, but it'll be out sometime in March, we're hoping. And I don't think an Audible version will be there right at the same time, but it may be months after somebody has the final book and can narrate it.
Okay, and for the two books that you've already written, are they available in soft copy?
The two books, Panic Proof Investing, you could go on, I believe, Amazon and some places and find it. It's getting to be a little old at 1995, but I think it's still being offered by Wiley, and they can print out more copies, and away you go. On the electronic book, it's only $10. You can go to my website and buy it, enjoytheride.world, and go to the Learn store and just look down for, you can get a PDF version. You can print it out if you want on your own printer, or you can just keep it in the electronic world. There's an ebook version. If you want Kindle, you'd have to get that from Amazon, I believe. I don't have a Kindle version that I'm selling. Amazon sells the Kindle version, but that's also available for $10. So that's why it's so inexpensive. I priced it that way to make sure everybody has a possibility of doing good position sizing. I'm not trying to make a lot of money. It's not going to change my life if you buy the copy or don't buy the copy for $10, but it covers my costs. It contributes to my website and keeps it alive, and so everything's good. But that is sold thousands and thousands of copies now worldwide.
All right,
only electronic. There's no hard copy of that one.
Oh, okay. All right, thank you. So for the last question, do you offer any course in automated trading, or how you normally go through your process of developing an automated system? It's Noel who was asking.
Cost?
Course, like an educational series where you take people through.
I do have a video series that covers the entire process of developing a trading strategy, and that's also on my website at the Learn Store. It's the most expensive thing because it took me 6 months to put together, and it's extensive video, lots of examples, each one at least a half an hour, with lots and lots of information that's provided. And I think that that's a good roadmap for people to follow, to start from scratch and do some personal inventories of themselves, get into a buy sell decision and understand data, understand portfolio selection, understand sizing their positions, understand the whole concept of psychology and the types of things that you got to do, contingency planning and that's all about with regard to trading. Things like if you lose your electricity right in the middle of the trading day, what happens? What do you do? If you lose your phone, if you lose your internet connection, if your broker goes down, because that happens. If you have a natural disaster in your area, what are you going to do? You've got to think through. If your wife calls and says the kids are sick at school, I got to go. You got to go pick them up and get them out of school. How do you? All right. What do you do? This is real life. Life impacts your trading, and you have to think through those things. So there's lots. I try to cover everything I could think of, and it's something like 16 or 17 video series. It's a pretty lengthy video series that covers everything I can think of to develop what you need to get all the way through it. And that's also on the Learn Store. There's also webinars. I've also done a number of webinars on different specific topics. If you want to hone in on a specific topic, from time to time, if people ask me to, and there's a topic that amuses me, my wife and I, she's my producer, she'll fire up her computer and I'll fire up mine. I'll get a PowerPoint put together and we'll do a webinar. So there's a couple of those on the Learn Store. I encourage everybody to just wander around. It's free. You can go to the website and just wander around. There's a lot of good stuff there. And some of it's free, some of it you pay a little money. It depends on what the individual item, but there's a lot of information on trading all in one place. So check it out.
All right, thank you. So we're running out of time, but maybe you can squeeze in one last question from
Sure.
Leo, asking, would you recommend any automated systems? Are there any automated systems you've come across that you'd recommend, maybe for a beginner?
All right, automated systems that I would change. That system to me implies that it's the buy sell engine and it's going to be giving you everything you need to trade. And I know of no system that does that. A platform, on the other hand, where you can design your own strategy and test it out and decide what you want to do. There's a number of them, depending on what you're trading. I think they all have weak points and strong points. The platform that I was showing you, SimTrader, that I used for this presentation is in its early stages. And as I said, I'm trying to help design it. I'm kind of the consultant on it, if you will. And I'm getting the stuff built into it that I think is required for being a good platform. It still won't give you a system. It'll give you a place where you can test your own systems and develop what you want to do. Because if I'm trading in 21 days and you want to trade at 9 days, there's no reason why we can't both coexist in the marketplace. But you need to design what you do and test it out and be comfortable with it so that you can actually execute it. So I hope that answers the question, but there's nothing, a hardwired system that I would take and go off and trade. I would never do that.
All right. Thank you. I think that marks the end of the Q&A session.
All right. Okay. Before we wrap up the Q&A session, I would like to give a question from an STL member. He asked me to ask you, when it comes to automated trading, what is the sort of like the ideal trading capital that one needs so that they're not, number one, undercapitalized, and so that they don't also stretch themselves too thin when it comes to trading. And then one last question from me when you're doing your system designing, how far back did you go with data and your quantitative analysis when it comes to back testing to be comfortable? Because you can be, like you said, you can't be 100% guaranteed. What is the timeline that you looked into to design your system?
Okay. First question again, briefly, is
Capital.
The trading capital, the
capital.
ideal?
Capital. Okay, capital. Capital and time. Capital depends on what you are going to trade. If I was trading exchange traded funds in the US, for instance, I know I can go in and buy 5 shares of a broadly diversified mutual ETF or exchange traded fund. And if I put together several of those, I know based on the prices of some of those, I could probably start doing some trading with $500 to $1,000 US. On the other hand, if I'm trading futures contracts and I want a 20 contract portfolio and I want to put in fancy position sizing and I only want to run 1% risk of my portfolio equity, then I know mathematically it's going to take somewhere around $1 million US. So it's very, very dependent on how you design what you do. And that's why I recommend everybody take the time to sit down and say, how much capital am I going to trade? Because each person has a different amount of capital. And how much time can I spend? And what skills do I have? And what markets am I familiar with and I'm going to trade? If you're in India or some other countries, you might not be able to trade US stocks. It's maybe in some countries against the law to trade US certain. In Europe, you can't trade the largest traded instrument in the US, the SPY exchange traded fund, which is the Standard & Poor's 500 exchange traded fund. In Euroland, you cannot trade that. It's illegal. So, or you can't short it, I guess. I don't even know if you can trade it. So that your own country and where you are and what your capabilities, skill levels, capital, that's going to dictate how much capital that you need to get started. But I encourage you to design what you do for your own capital, and it could range from 1,000 to 1,000,000 or more. Sometimes when you get much above 2-3 million, there's a diminishing benefit. You're just doing the same thing with larger size. That's that question. How long do you need for a study? People seem obsessed with going back to, I don't know, 1970 or something. That's ridiculous. What I need when I design a strategy is I need a positive period towards my strategy, and I need a negative period that goes the other direction. So an up market, a down market, and a sideways market. If I could get that data in a 2-year period, that's sufficient for me to understand my trading strategy and decide whether or not I want to use it. And so it has to have everything. It has to have an up period, a down period, and a sideways period. And however long that is, that would be the minimum amount of time I'd like. If I can get a couple of up periods, couple of down periods, and a few sideways, all the better. But not more than 10 years. Don't be obsessed with going back in history. I mean, let's face it. I mean, 1974, when I came out, there was no computers. 1980 is when they came out with the personal computer. So that was 6 years after I graduated from college. When my senior year of college, I was using punch cards. They didn't even have terminals, personal computers, or anything, and calculators had just been invented. So don't go back to 1970 and look at the data. 10 million shares a day traded on the New York Stock Exchange was break open the champagne. That's record volume in 1974 at the end of the bear market. Today, the SPY exchange traded fund itself, by itself, trades over 200 million shares. It's a different world. Don't go back and research the prehistoric days. It just not going to relate to some of the stuff that's happening today. So try to go back a reasonable amount of time, but don't be obsessed with it.
Okay. All right. Is there maybe one last question?
Yeah, so
Yes, this last one here. This is Gordana who is asking, what are the main skills needed for successful automated trading?
I would say the most important thing is your whole mental side, your mental process, the ability to understand what the computer is doing so well that you're comfortable delegating that day-to-day activity, the discipline, the self-confidence, the self-assuredness of that you understand what's going on, and the automation is an extension of you, and it's taking care of the heavy lifting for you, and you can trust it. That's probably the critical thing, because you'll override it or abandon it or do something to mess it up if you don't have that. On the automation side, I would concentrate first on position sizing appropriately, and secondarily on getting your direction right with the buy sell. So in order of priority, mental side first, position sizing second, and the third most important is your buy sell decision. And that's exactly the opposite of what most traders think.
Absolutely. And with that, I think we can wrap up the Q&A session in the interest of time.
Okay.
And Gilbert can help me read out Tom's, if people want to reach out to you, you have that, but you can read them out loud. We'll fix that.
Well, on MeWe, which is my favorite platform, MeWe.com, I am MeWe.com/I/Tom Basso. Parler is offline now. The AWS servers were removed from them, so I don't know if they'll ever come back, but if they do, I'm at enjoytheride.world. Twitter, I'm at Basso_Tom. And there's been several imposters there, so be careful. Facebook, I'm at enjoytheride.world. Don't send me a friend request to my personal Tom Basso. You'll just get a message back that says, follow me on enjoytheride.world, and you'll get all my posts. I don't ever post to my personal Facebook, so it's useless to become my friend on Facebook. It's better to follow the enjoytheride.world. And the easiest place with all of this information is to go to enjoytheride.world itself, and there you go. You got everything you need, all the videos, the webinars, the books, everything that I've done in my life, my history. My research papers are free. All the interviews I've ever done are free. Lots of stuff there. So you can enjoy yourself learning about trading from enjoytheride.world.
All right. Thank you, Tom, for making the time and even extending beyond our time limits.
No worries.
Yes, and we'd love to have you again in the future if your time allows.
Happy to do it.
We also wish to thank Scope Markets Kenya for sponsoring this webinar. And we'd like to also say that people should not be limited. If they want to be automated traders and they don't have the coding background, they can hire programmers to do that for them. And you can be able to plug in your trading robot on Scope Markets trading platform, the MT5 trading platform, and then you can apply the lessons we have learned in this webinar once you fund your live trading account with Scope Markets Kenya. So thank you so much, Tom. We'll let you go for now.
Okay.
It's been a pleasure, and thank you so much, Gilbert.
Well, have a great evening.
Yes, thank you so much, Tom. I've learned a lot, especially for with regards to automated trading, because I'm quite keen on that. And based off of your point that, automate something that you're already doing. So that's exactly the advice that I'm going to take. So thank you for that.
Well, good for you.
My last takeaway is that you don't need to even buy a trading robot. You can just design your own based on your trading strategy. So thank you so much for that info.
Great.
All right, bye.
All right, bye.
Bye-bye.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.